Everyone. Welcome to your very important topics, deliberation, discussion, which is capital gain from the topic of income tax. And this topic, as we are proceeding further, is adding a lot of knowledge to you, not only relating to income tax, but also it is increasing your general knowledge about business, about various types of transactions, and that is also helping you to grow in your understanding and develop as a professional. That is the best part of studying such topics, that whenever you study these topics for understanding what are the tax provisions, at the same time you also understand, okay, this is how transactions happen, this is how a particular type of things takes place, right? So let us start. Yes, very good morning, Dhanalakshmi, Anchal, Santosh, and everybody present. Students, we now completed two major parts of our topic, the core, that is what is transfer and what is capital asset. In transfer, we studied what is transferred and what is not transferred, and also the same thing in capital asset. So firstly, anybody has any queries, doubts, please ask. Santosh is asking, when question answer, test your knowledge. Santosh, beta, if you remember, in PGBP, we have already solved around 7-8 questions, or even more if I'm not wrong, from your test of knowledge. The remaining are for your practice. You solve them. If you have any queries, doubts, you can anytime ask me, Santosh. Similar thing we'll be doing with capital gain, because see, until unless you know the provisions, you cannot solve. So we have to first understand, make ourselves clear with the provisions, because without provisions, how can you solve any question, right? So we are right now developing our understanding of the topic, and then we will be definitely solving sums like what we did for PGBP also. Now, what we studied in the previous class relating to capital asset, I'm just putting down here. So it will also be a revision, and it will also be a notes taking for you. So we understood what is a capital asset. Section 2 clause 14 defines it as a property of any kind. When they say any kind, it may be movable, immobile, tangible, intangible, personal, business, any kind, which is held by the assessee. However, as a rule of this chapter, whatever you study, there has to be exceptions. Exceptions means what will not be considered as capital asset. Now, in exceptions, the first thing that you have is stock in trade. So raw material, finished goods, packing material, anything belonging to your business in which you trade is your stock in trade. Now we all know why it has been excluded, because any income arising from sale or transfer of stock in trade goes to PGBP. Next, very important exception. Movable personal effects. Now, when we talk about personal effects, whatever you are using for your own self or for your family, for your day-to-day needs, they are called as personal effects. So they are out of taxation because they are not treated as capital asset. However, we have exception to exception, means certain things are excluded from this movable personal effects part, which is an exception. So in short, these are capital assets. What are they? Jewelry, paintings, archaeological collections, sculptures, and work of art. Now, these things, even though held by you for personal use, will be treated as capital asset. Correct? Yes. Correct answer. Correct, Arun. Now, the next exception is rural agriculture land, which is agriculture land not situated in urban area. And how is urban area defined? Area covered under municipality or cantonment board, and try to recall, students, as I'm revising and writing, having population either equal to or greater than 10,000. Correct? So the law has said agricultural land not situated in urban area, which is defined as an area on for which you have municipality, municipal corporation, cantonment board, which is governing that area, which is the local authority of that area, and where the population is either equal to or greater than 10,000. Right? One second. The symbol has to be like this. Now, if you remember, besides the area, which is, let us say this is the area. So this area, if having population of 10,000 or more and covered by municipality, is urban. But not only this, surrounding area up to some specified kilometers is also urban. How much is that kilometer? Up to 2 kilometers, up to 6 kilometers, up to 8 kilometers. And this depends upon the population. If the population is between 10,000 to 1 lakh, if it is between 1 lakh to 10 lakhs, and if the population is above 10 lakhs, then that area is also urban area. So let me call it as specified area beyond above municipal limits. So whatever is in the municipal limits, that is urban. And then some part of the area beyond the municipal limits will also be urban, depending upon the population of that area. Yes, Anshul, correct. Then you have some specified bonds, gold bonds, special bearer bonds. So these are all considered as not a capital asset. Out of this, the most important ones is this and this for the purpose of exams. Now, this is the main part of the definition of capital asset. Now, there is one more part in this definition. Besides this, two more things which are capital assets are securities held by FIIs, and two, ULIP issued after. What is the date? Yes, students. What is the date? 1st April 2023. Correct? Students. A, this is B, this is C, right? So these are the important concepts relating to capital asset. Right, students? So we completed the two major parts which is required for attracting this chapter. This head, that is, you should have an asset and the asset should have been transferred. So we first studied what is and what is not transfer. Then we studied capital asset as to what is a capital asset, what is not a capital asset. Now, in capital asset, the next point is types of capital asset, right? Okay, Arun is asking, sir, for a municipal area, which population criteria apply? 10, 1, 10. Huh? I did not get your question. For municipal area, which population criteria apply? It is, see, Arun, there are two parts in the question, in the definition. The two parts are, firstly, you have to determine whether your area is a municipal area, yes, having population of 10,000 or more. If that is the case, then that municipal area, like in my example, in my drawing, this, so this area, which we are saying is a municipal area that is having a municipality, this area should have a population of 10,000 or more. Once this area has a population of 10,000 or more, this area is a urban area. What is the requirement? 10,000 or more. Correct? So
Yes,
for
sir.
that area to be a urban area, that area's population should be 10,000 or more. Here, 1
Okay.
lakh, 10 lakh
Sir,
is
I'm
not required.
asking the 1 lakh and 10 lakh population, which is inside the municipal area, otherwise the range. Okay, the municipal 6 kilometers surrounding the population you're counting.
So that is what I'm explaining, Arun. So first is, there are two parts in this definition. In first part, we are talking about this circle itself, or this whatever area itself. That area is to be called as urban. And then in the second part, we have to see whether the periphery of this area has to be treated as urban. Correct?
Yes, sir.
So this area will be treated as urban if its population is exceeding 10,000, right?
Yes.
Now, once this area is urban, Now you have to determine the periphery. How much surrounding area will be urban? Now, for deciding the periphery, that periphery can be of 2 kilometers, 6 kilometers, or 8 kilometers. Now, out of these kilometers, which kilometer periphery is applicable to you to decide whether my surrounding area is also urban or not? So, for that, they have the condition of population range. If the population of this area, again, which we have already decided as urban, is between 10,000 to 1 lakh, then you will take periphery of 2 kilometers. Now, in that 2 kilometers, whatever is the population, that makes no difference. Similarly, if again of this urban area, which you have already decided as urban area, the population is between 1 to 10, then the periphery around this area, which has to be taken as urban, is of 6 kilometers. Again, you will not see the population of the periphery. The population has to be seen as of the main area. Are you getting this?
Yes, sir.
Clear now?
Yes, sir.
Arun?
Yes, sir.
Perfect. Now, in types of capital asset, what have we discussed? What are the types of capital assets, students? Yes, what are the types of capital assets? Okay. Long term, short term. Very good. Now, section 2 bracket 29A defines long term capital asset as a capital asset which is not short term capital asset, right? Section 229B defines long term capital gain as gain arising on transfer of long-term capital asset. So two definitions, long-term asset and long-term gain, right? So the definition is in section 2, clause 29A, 29B. 29A defines long-term asset as an asset which is not short-term. 29B defines long-term gain as a gain which arises on transfer of long-term asset. Then comes the definition of short-term capital asset. And then the definition of short-term capital gain. Now, short-term capital gain is simply mutatis mutandis to the above definition, which says short-term capital gain is gain arising on transfer of short-term capital asset. Right? Now, what is a short-term capital asset? For that, you have two criterions. For listed shares, debentures, bonds, you have one rule, right? Plus units of equity oriented fund, right? And also so these are short-term capital asset if held for not more than 12 months immediately before the date of transfer. Correct? Is this clear? Then for all other assets, we have the 24 months rule. So everything else is mutatis mutandis. you have to check 24 months. Now again, with every provision, there has to be an exception. So you have exception. Now in this exception, something is expressly written in section 50AA and something is written in some other section which we did not study in the previous class, but you will get to study that later. I'm putting all the exceptions together. So first exception which we studied in the previous class, yes, students try to recall. Good. Yes, Arun, you are right. No, Anchal. Anchal, you are mixing between two exceptions. Jewelry was exception of whether it is capital asset or not. Now I'm talking about exception to this 12 months and 24 months rule of deciding period of holding. Right? So you are correct in saying jewelry, but jewelry is not an exception to this point. Right now we are talking about exception to the 12 months, 24 months rule. See, so 50 capital A, what it says, the transfer of certain assets will always lead to short-term capital gain, right? Now, what does 50AA, capital AA includes? So what it includes? It includes units of specified mutual funds, market-linked debentures, unlisted bonds, unlisted shares. Unlisted bonds, unlisted debentures, right? Now, these are what is given in 50AA, which we studied in the previous class. Today, I'll add two more points in this, which we are going to study later. But since we are now making our notes, let me complete this point. So, section 50AA, what it says, if I have to make it short, units of specified mutual fund, units of specified mutual fund, again same date, 1st April 23, correct? Market linked debentures and unlisted bonds, unlisted debentures, right? This is the first thing. Second, which you are going to study later, 50 bracket 1 bracket 2, those are depreciable assets under block method. Now students, this was the last part we did in PGBP. If you remember, in PGBP when we were studying depreciation, I had also taken the capital gain computation of those assets. And if you remember, we had taken the rule that the gain or loss arising on transfer of these assets is always short term. So what is the exception? The exception is that when you are transferring these assets, it may be of more than 12 months, 24 months, but the law has specifically made an exception saying that you have to treat them as short term. So even if it is beyond the 12 months, 24 months period, you will not consider it as long term. The gain or loss arising from them is to be considered as short term. Similarly, we will study a case of slum sale. For slum sale, the period to decide long term, short term is 36 months. Now, actually, let me inform you, students, until 2 years back, there was one more criteria. So there were three criteria for long term, short term: 12 months, 24 months, and 36 months. Now they removed the 36 months rule and made only two criteria, 12 and 24. However, when we will study 50B, we will find that for slum sale cases, in some sections, there is still a reference of 36 months. My personal interpretation is this is an error of drafting, because the intent of lawmakers when they removed this 36 months rule, see, 36 months rule was there, and it was there for a very long period of time, right from the time I was studying, that is more than 25 years, 26 years back, this rule is there. Now the point is, now when they have removed this rule technically was removed totally. However, you will find reference of many things in many sections, like depreciable asset we found in PGBP provision also, here also. Similarly, for slum sale, where you found reference of slum sale in another section, which is 50B, somehow while making this change of removing the 36 months rule, I believe the lawmakers missed to make the change in that particular section. And that is why today the position of law is 50B is not yet amended and it still uses the term 36 months. So we are also following the law as it is written today. Maybe in future, whenever this point will be highlighted to the government in any upcoming budget, they may correct this. But as on date, the rule is 36 months for deciding long-term, short-term in case of a slum sale. So these are the various exceptions relating to deciding long-term, short-term asset. Right? Is this clear to all? Fine, students. Should we proceed? So we have completed the main part of deciding capital gain, whether capital gain is applicable or not. That is asset and transfer. Now we go to the next part, which is computation. So from today, we are starting how to compute capital gains. Now again, going back to what I had explained at the start. So once you have decided that capital gain is applicable, you have to do this computation, which is given over here. As you can see, I had already given you the computation. Now this computation is given in section 48. So section 48 of the Act has prescribed this format. Now we have to discuss each and every component of this computation. But before I start explaining each and every component, the very first component of computation So before you start computation, the very first thing that you have to decide is whether your capital gain is exempt under section 10. Now I'm sure by now you all know that there is something called as exemption, which is simply put those incomes on which the government does not want a tax today. Those incomes the government has put in the section 10, which is the section for exemption. Now, when something is put in section 10, like for example, agriculture income, share of profit received by the partner in partnership firms. So in all these cases, which is put in section 10, the effective meaning is that you don't have to pay tax on those items because the government has treated it as an exempt income. Now, when you studied salary, you studied many exemptions, like you studied exemption for gratuity, commuted pension, leave salary, right? Similarly, you have exemption for different types of incomes. Now, when we come to capital gain, section 10 again has some exceptions. I'll not call them as exceptions, exemptions relating to capital gain. So if your case is falling in any of the exemptions of section 10, then obviously you will not be required to pay tax, and hence computation is not required, right? We will study that as we get it in the module. Now let us say your case is not falling in the exemption category. Then will come the second part. Now once you have decided that, okay, my income is covered under this head of capital gain, and also there is no exemption because there are only two exemptions as on date for capital gain, and your case is not fitting in those two. Then what will happen? Now you have to do computation. Now in computation, you have to first determine what is this year of chargeability. Now please understand, students, what is year of chargeability? I will write year in which tax has to be paid on capital gains. So what is year of chargeability? So it is the year in which you have to pay tax on capital gains. Now you'll say, sir, why it is so specifically discussed here? Because till now, in all the other heads, including the one which we are going to cover later, that is other sources, we have never discussed this year of chargeability. Why? Because all other incomes like salary, PGBP, HP, these occur every year. So it is on regular basis. So we know that every year you have to consider that income in HP, that income in PGBP, and so on. But capital gain, it arises once because it is on sale of asset. You do not sell asset every year. Maybe in 10 years, once you are going to sell the asset. Now, when you are selling an asset, many times what happens is that the transaction of asset, since it is of high quantum, it may involve 5, 10, 20, 50 crore rupees. So the transaction is stretched over 2 or 3 financial years. Like I'll give you a simple example. You book a flat in some building. That flat is under construction. Construction takes 2 to 3 years. So for these 2 to 3 years, you are paying some installment to the builder. Now, definitely this income is not covered in capital gains because for builder it is a PGP income, but I'm trying to give you an example of what I'm saying. So when your transaction in this case is over 3 years, the question is, out of these 3 years, when will you pay tax? Will you pay it proportionately in all the 3 years? Answer is no. Capital gain do not have this concept of paying proportionately. Now, what is the rule? The rule is year of chargeability is year in which transfer of asset took place. This is what is given by section 45 bracket 1. So when do you tax? You tax in the year when you transfer the capital asset. Now this is the rule. Now if this is the rule, there has to be what? So if now you have a rule, along with the rule, what you need to know? In this chapter, with every rule, what comes? Yes, Dhanlakshmi, correct. So for every rule, you need to also study the, yes, Krishna, correct. You need to study the exceptions. Now, firstly, what is the rule? In case of capital gain, the year in which you have transferred your asset, that is the year in which you have to pay tax. Maybe the money may come later, maybe something may happen later, something may have happened earlier, makes no difference. The year of chargeability is year of transfer. Now, exceptions. What are the cases when year of chargeability is not the year of transfer? Now, first comes section 45(1)(a). That is in case of insurance claim. Yes, sir. Very good. Now, within insurance claim on destruction or loss of asset by fire or natural calamities like flood, earthquake, tsunami, etc., or war or internal disturbances like riots. So for all these cases, year of chargeability is year of receipt of compensation. So when do you tax it? You tax it in the year not in which the transfer has taken place, but the year in which the insurance company paid you the compensation. Correct? Now, we have similar more such exceptions, but right now my focus is not on the year of chargeability and its exceptions. My focus is on the computation part. But why I just highlighted this, because now when we will start solving sums, the first thing that you have to check in the sum is, first step one is check if capital gain is applicable, that is asset and transfer both are present. Second, check if you are not covered in the exemption under 10. Third, find out the year of chargeability. Until unless you find out these three things, you will not do the solving. Eligibility or applicability, whether capital gain applies. Two, is it exempt under section 10? Obviously, the answer should be no. And third, in which year you should pay the tax. Once you have decided this, then you will do the computation. So I'll just keep this part blank, because right now this is not my interest of discussion. That we'll discuss as we go to each of the cases, and we'll start adding when we go to the cases. Right now, I want to teach you the computation. And for computation, the first thing that you require is FVC, full value of consideration. Now, section 48 defines full value of consideration. Now, simple words, what is full value of consideration? It simply means that when you have transferred your asset, which is the trigger point, whatever consideration you receive in return, that is your full value. So it can be monetary consideration. So for transferring the asset, whatever money is received, or if you have given asset, the other person is also giving you something in kind. So let us say I have sold you my building, you are giving your jewelry in return. So your consideration is in kind. So if something in kind is given, then FMV of the asset received. So this is what is your full value of consideration, which you have received against transfer of capital asset. So whatever you receive against the transfer of capital asset, which may be money, or if something is received in kind, then the FMV of the item received in kind will be your full value of consideration, right? Now, after you have done full value, see, keeping something blank. Why? Because as you know, everything will have exceptions. But now I want to start practical sums. So I need to first create a background for the practical sums. That is what I'm trying to do. So next is cost of acquisition. Now, cost of acquisition is defined under section 55 bracket 2. So you have to subtract cost of acquisition, we all know. So what is cost of acquisition? 55 bracket 2 says cost of acquisition is same like what we have studied in accounts. It is the purchase or construction cost of the capital asset plus all expenses incurred until the asset is ready. Same like accounts, nothing new, nothing different. So what will be cost of acquisition? The main amount, which is the purchase or construction cost, and all other expenses like registration costs, legal costs, whatever you have incurred in order to acquire the asset, all expenses till the asset is complete or ready. So nothing new, same like your accounts. But again, we have exceptions, right? Then comes cost of improvement. What is cost of improvement? It is the capital expenditure incurred after acquisition in subsequent years. So it is the capital expenditure incurred after the acquisition was done. So first is acquisition. So first time whatever you incurred for purchase construction, that is acquisition. Now that is done. After, let us say, 3 years, you add something. So let us say I purchased or constructed a building of 3 stories, 3 floors. After 4 years, I added 2 more floors to this 3-storied building. So now the building has become of 5 floors. So this 2 floors, which I added later, which I constructed later, will be my cost of improvement. So cost of improvement has to be a capital expenses which is incurred after its acquisition in the future years, which increases the value of your capital asset. So it is something which increases the value of the capital asset. That is cost of improvement. Students, I hope you are understanding this. So for our format, we required these figures. So full value of consideration, sale value, expenses on transfer is expenses which incurred for effecting the sale. And then 2 types of costs, cost of purchase, that is acquisition, and later on any future capital expenditure. This is fine. Now Krishna is asking a question which is relating to our previous class discussion. So he's asking, sir, we consider bullion as a capital asset, but why utensils of gold is not under capital asset? See, I'll tell you. So basically, bullion is what? So firstly, let us understand bullion because this question is addressing to bullion. So bullion means raw gold, raw silver. So when you have gold in the form of gold biscuits and you have silver in the form of silver bricks or silver biscuits. Now, since silver is also very costly, maybe in future we will not be buying the brick, we'll be buying the biscuits again of silver. Now, when Your gold, silver are in the rawest form. There is no work of any type is done on them. They are in the original raw form. We call it as bullion. Now Krishna is asking, sir, bullion is a capital asset? Firstly, we have to discuss this. Is bullion a capital asset? So answer is simple. Check the definition of asset. Is it a property of any kind? Answer is yes. Is it falling in any of the exception? First, is it stock in trade? If you are a dealer of bullion or dealer of gold, silver, then it will be stock in trade. So we are not talking about jewelers and dealers. We are talking about you and me who are not into the business of gold, silver. So is it your stock in trade? No. Is it your personal property? See, personal property means something which you can wear, which you can use. Can you wear and use raw gold and silver? No. So it is also not personal effect. And obviously, it is not rural agriculture land. So by default, it is a capital asset. Now, first part is clear in Krishna's point that bullion is a capital asset. Now, his counter question is, so it is treated as a capital asset. But when we talk about utensils, why it is not treated as a capital asset? So Krishna, for that, please understand and appreciate this point that when we talk about utensils, utensils are made in such a fashion that they are for personal use. Now, the moment it comes to personal use, you have to go to the exception of personal use, and in personal use exception, you have an exclusion where even personal use items will be taxed. Now, what is that exclusion? That exclusion is jewelry. But interestingly, as we discussed in the previous part, jewelry includes two things. First is ornaments. Now, definitely utensils are not ornaments. Ornaments made of gold, silver is treated as jewelry and hence it is a capital asset. And when it comes to furniture and utensils, over there in that point, they had not made a reference of uh, metals. They had made a reference that if it is studded with any type of metal, precious, semi-precious, then it will be jewelry. So we concluded in that particular discussion in the previous class that any silver utensils that you have, and we all have it, right, will not be jewelry and will not be a capital asset, right? Now we come to your point. What about utensils made of gold? Now I understand what your intention or your reason of asking this question is. That tomorrow, if I want to evade a tax, what I can do easily, I will buy raw gold, but while taking the gold, I will tell the jeweler, do one thing, just make a small cup out of it. Just make a small spoon out of it. Because anyways, we will not buy gold in kgs, we'll be buying few grams. So I get some utensil shape made out of it, right? Now, the moment I may get made a utensil out of it, we have said that utensils which are of precious metal will not be jewelry. And it is not jewelry, it means it is not a capital asset. But wait, first is that when you are reading the definition of capital asset, first is the exception. What is the exception? Personal effects. And within personal effect, you have jewelry. Now we are directly looking at the jewelry definition and saying that gold utensils are not jewelry, hence out of capital gain. But wait, come a step before. Firstly, from capital asset, what is excluded is personal effects. You have to first prove that the gold utensil is a personal effect. Now, what you have said is very correct, that people may misuse it by converting all their gold items into utensils so that tomorrow, whenever gold prices rise and they sell them, there will be no capital gain. But this will not happen. I'll tell you why. The reason is you are not fitting in the exception itself. What is the exception? It should be a movable personal effect. And what is a personal effect is determined by practice, customs, traditions. Now, the moment you say this, see all our customs and traditions, whatever you are following in your family, in your culture, whatever we all are following. In how many of our customs we have reference of use of gold utensils? Practically not. I'll tell you simple examples. When a child is born, what does our tradition says? That the first thing that you make the child eat is with silver spoon. And that is why there is also a saying which says that the child is born with a silver spoon in his hand. Have you any time seen in any custom that it is a golden spoon? No custom says that. Similarly, in all our rituals that we are doing, you will find the use of silver utensils. In so many traditions, wherever some prestigious person has to come, you serve food in silver utensils. Observe this. Now then, will gold utensil be never be treated as personal effect? The answer is no. I'm not giving you a rule, otherwise that would have been written over there. If you are belonging to a Raja family, in Raja families, there was a custom tradition of using gold utensil. So, all this what we have discussed, when you'll come to finals, see finals, the provisions will be same. What new you are going to study? I'll tell you, final is very, very, very interesting. Same topics, same salary, same HP, same PGBP, same capital gain. Why? Because at final level, you'll go to such depth of each point. You'll be studying relevant case laws, judgment that have come on this point. And let me tell you, whatever I'm telling you right now, there are judgments on this where people actually started misusing this definition of jewelry to evade tax. One, they started creating gold utensils. There are judgments saying that it is not a custom tradition to use gold utensils. Exceptionally, one or two customs or tradition may be there, then that you have to prove. Second, until and unless you belong to a Rajashahi family where it was a custom, where it was a tradition to use gold utensil, if that is not the case, then we will not treat gold utensil as your personal effect in the first place. And the moment it is not treated as a personal effect, you need not go to the definition of jewelry. Similarly, I'll just add one more point. We discussed in the previous class, I gave example of silver utensils, right? Now there are even cases where people started purchasing silver and converted into utensils like 50 sets, 100 sets. So they had 100 sets of silver plate, silver vati, silver spoon, silver glass, everything. Now, importantly, even in those cases, the judgment that came was that even though usage of silver utensils is part of custom, but if you are a family of five, how can you justify that 100 sets of silver utensils is your personal use? And that is where the courts gave decision that in a family of five, that is, so they said, depending upon your family size, whether it is a joint family, and depending upon what type of culture you follow, we will consider some number of silver utensils as reasonable, as legitimately for personal use, and all excess will be capital asset because it cannot be said to be of personal use. Right, Krishna? I hope everybody else also understood this. That is why the final point is that silver utensils up to a reasonable number will be treated as a jewelry, will be treated as not a capital asset. But other than that, other things like gold utensils and silver utensils in excess quantity will not be considered as a personal effect in the first place. You don't have to go to the definition of jewelry then. It will become capital asset there itself. Fine, students. I hope it is clear to everyone, right? Okay. Okay. So now we start with computation. Now what does 48 says? So for computation, 48 says that whatever income is taxable under this head, it will be computed by deducting the following items from full value of consideration. And what are the items? Expenditure, cost of acquisition, cost of improvement. Further, it says that cost of acquisition or improvement will not include that amounts for which you have already claimed deduction under some other sections of this income tax law. So where you have taken deductions of the costs in 24B or in chapter 6A, again, you cannot get two deductions for the same expense, right? So that is what is clarified. Now, in expenses on transfer, this is the only exception. So let me just write that point also. Expenses on transfer. So here we have said that what we will exclude or deduct while computing capital gain, expenses on transfer, and expenses on transfer will be commission, advertising, legal, registration fees, all expenses necessary for transferring the asset. Now here there is an exception. So I'm writing it here itself because it is only one. STT paid on securities. Now I'm sure you all know this, that whenever you are selling share, debenture, bonds on the stock exchange, so you are selling these securities through the stock exchange charges you a small amount called as STT, Securities Transaction Tax. Now this STT, which the stock exchange has charged to you, this STT will not be allowed as a deduction here. So you cannot deduct it under the name of expenses on transfer. In other words, that STT will never be allowed, right? Now, interestingly, students, when we say this, immediately the next point that comes to your mind is, yes, sir, we studied something relating to this STT earlier also. The answer is yes. We have studied something relating to STT earlier. That is what is in PGBP. Now, interestingly, if share trading is your business, sorry, if share trading is your business, then the income goes under the head PGBP. Over there, while computing PGBP income, under section 36 bracket 1, STT paid on the share securities that you have purchased, sold through stock exchange, it is allowed as deduction. However, in capital gains, it is not. So have this comparative point also in your mind that when you are computing PGBP, in that it is expressly allowed the STT paid on transfer of shares. It is treated as a deduction under 36(1). Whereas under this chapter of capital gains, wherever you are paying STT while computing income under the head capital gains. Now, when you will be paying STT here, so for you and me, shares we are buying only as an investment. We are not into the business of dealing in shares. So whatever STT we pay at the time of sale of these shares over the stock exchange, that is not allowed as deduction. Is this clear, students? Now, another important thing while computing capital gains, see, I have put a star, and for a star, I have written indexation. Now, this is a very interesting concept in capital gain, which is called as cost inflation index, right? Now, what is cost inflation index? What is this indexation? Let us understand. So, let me first give you an example to make you understand what is this indexation. Now I purchased a piece of land in 2004-5 for rupees 10. Right? Now we purchased this for rupees 10 lakhs in 2004-5. Just a minute, student. Now I sell this land today in 25-26. I get rupees 25 crores. Now, as per our plain understanding, how do you calculate capital gain? Full value of consideration 25 crores. Now, actually, it will not be 25 crores. It can be different because of the stamp valuation rule, which we studied in PGVP also. That we'll study here again. But for the time being, I'm writing 25 crores. Now, from this, cost of acquisition is 10 lakhs. Now, if I simply subtract this 10 lakhs, I get a huge amount of capital gain. Now, see, the law has nothing to do whether you get a huge amount or less amount. But the point is the value of my land actually increased, or I am getting a higher amount because inflation has increased? Now, here it will be both. But I'm sure you'll understand and appreciate this point that whatever value has increased, some part of it, or maybe in some cases, major part of this value increase is because of inflation. We normally use this terminology. Our parents also say that today you don't have value of 100 rupees. In our times, even one rupee was very valuable. We could buy so many things in 1 rupee. Now, what they could buy in 1 rupee, today maybe we have to pay 50 rupees for the same thing. You all will agree with this? Why? Because over a period, inflation has increased the cost and the price of all the items. Now, the law was very considerate about this, and the law said you will not deduct the 10 lakhs cost as it is. Then what you will do, you will take the full value and you will inflate this 10 lakhs. Mind my words, I'm using the word inflate. Inflate means you will increase this 10 lakhs to bring it to today's inflation amount. In simple words, 10 lakhs of 4-5 would be how much in 25-26 as per inflation? Like I just said, na, what you could buy for 1 rupee today, you are getting it for 50 rupees. So we say 1 rupee of 4-5 is now 50 rupees of 25-26 because that is the inflation. Same thing, 10 lakhs of 4-5, how much it will be of 25-26. So for this, we have indexation values of each year. So what we simply do in the numerator, we take inflation value of the current year, that is 25-26. In denominator, we'll take inflation value of 2004-5. So automatically, since current year's inflation value will be higher, let us say this amount will become 5 crores. I'm just giving an example. Now you'll subtract this 5 crores and you will get your capital gains long term as 20 crores. If you don't subtract this, the capital gain will be 24 crores 90 lakhs. I hope you are getting this difference. So this is the concept of indexation, what I had written over here. So not right here. Red is for exceptions. So this is the concept of indexation. So what is indexation? Inflating the cost of acquisition, cost of improvement of past year to bring it to money value of today. So in my example, 10 lakhs of 2004-5, what is the value of that money value of that 10 lakhs today? Obviously, it will be much higher. It will be inflated. So indexation means inflating, right? Now, when I was explaining this, I said the law was considerate and the law provided for this indexation. However, in 2 years, many things have changed. You will find in capital gain, there are many changes from 22, 23, 24. These years are very crucial years in capital gain chapter because many provisions have changed and the position today is this benefit of indexation. Firstly, I'm sure you'll understand why they are calling it as benefit, because if you index it, that is, if you increase the cost, if you inflate the cost, so instead of 10 lakhs, you are taking the cost as 5 crores. What is the direct benefit? Your capital gain has reduced. So if the amount of capital gain is reduced, automatically you'll understand you'll have to pay less tax. Whereas if you do not index it, like how here I did, I took the cost as it is. So 10 lakhs was given, I subtracted 10 lakhs. My capital gain is very high. So I have to pay more tax. So definitely indexation gave you benefit. The benefit was, since it inflated the cost, your final capital gain amount on which you have to calculate tax was reduced. However, as I said, this was the provision because this benefit is allowed only if your transfer has taken place before this date. Now, in our exams, our sums would be of 25-26 PY. It means the transfer would have taken place in 25-26, much after this date, which means now, while calculating capital gains, this will not be our method. Our method would be this, that is, we will not index it, we will take the cost as it is. So now indexation is not available to us because this point was amended 2 years back, where the law was amended to say that only where transfer took place before this date, which is in TY 24-25, and we are going to solve sums of 25-26. So if the transfer took place in this date, before this date, only then indexation will be allowed. Now, let me tell you one thing. I have said this. Every rule in this chapter should have an exception. So even this rule has an exception. This is the exception to this rule. So what is the rule? That indexation is not allowed today. So what is the rule? The rule is that indexation is now not allowed. This is the rule because this date is gone. However, you are given an exception. What is the exception? If the person is individual HUF, then option is given to them. Option of what? That they can take indexation benefit, but only for two assets, not every asset. Land or building, provided it is acquired before this date and sold today. So what is the crucial point? That The exception to this rule is very strict, very specific. You are individual HF, your asset is land building, which was purchased, which was acquired by you before this date. That is the date on which indexation is removed. So you had purchased the asset, the land or building. So this will not apply to jewelry, shares, or any other thing. It will apply only to land or building. That too, if it is purchased before this date, and now you are selling it. So if you have purchased the land building before this date, and now you are selling it, and you are individual HF, you are given an option. It means both the workings apply to you. This also, this also. So for you, indexation is not compulsion. It is still an option. Importantly, this option is only to be checked when you are computing tax, not the income. Which means what? Right now, in this chapter, we are only learning how to compute income. Computation of tax, we are going to study separately in a different chapter. There is a whole separate chapter on tax computation. Today, even for individual HF, you have only one method, that is this. This method is not to be checked today. This is an option given to individual HF for only asset of land building. So the point, students, is that now in this chapter, since the questions that you will be asked, even in exams, you will be asked one question on computation of tax, and all other questions will be only on computation of salary income, HP income, capital gain income. When it is computation of capital gain income in our format, what we are studying, you have to only do it by this method, that is without indexing. See, this method is without indexation. So you are taking the cost as it is. You are not inflating the cost. The 10 lakhs is taken as it is. This is what is without indexation. So even for individual HF, this is the method. That is, you will not index it now. Now means while computing the capital gain income. Later, when you go to the computation of tax, which will be a working note, in the working note, remember one thing, you have already calculated income with this method, that is without indexation. So your income appearing in your computation is 24 crore 90 lakhs. Now when you go to tax computation, in the working note of tax computation, you will make both the tax computations, because here the tax rate is lower, here the tax rate is higher. This all things you will study in that chapter of tax computation, but just I'm telling you for your understanding. So what you will do in tax computation, this income multiplied by the lower rate, this income multiplied by the higher rate, you will compare the tax. Wherever the tax is lower, you'll go for that option. So if this tax is lower, you'll continue with this option. So maybe indexation may not be beneficial to you. It is reducing your income, but the tax rate is higher. So you will continue with this. But if your tax is lower in this option, you will only in tax computation go by this option. Means your computation of income will be like this only, which we say without indexation. In short, in this chapter, all sums will be solved without indexing, even for this case. Anyway, see, indexation is limited only to this one case. Your individual HF asset is land building. This will be very few cases. But even for these cases, while computing capital gain, there is no option in computing capital gain. Capital gain has to be computed without indexation. So your answer will only be by this, that is without indexation. This option is with indexation. This is an option given only in one strict case, and that too only at the time of tax computation. Income will remain 24 crore 90 lakhs in all cases. Students, have you understood this? Mahek, beta? Indexation is allowed to individual HF. Individual HF is the only person, and that also if they are selling land and building, where indexation is allowed. In all other cases, indexation is not allowed. So what is the rule? Main rule is indexation is not allowed. In that we have exception, which means indexation is allowed. Correct, beta? So students, in computation, this is an important point of discussion. I hope you have understood this. So see here it is given, but this part has to be checked only in tax computation, not in income computation. So see this point. Computation of income under CG, it is not to be included. Means you compute income by only one approach, that is indexation, not to be given. Understood, students? Fine. Chalo. So we take our break now, and after the break, we proceed with more provisions. Right? So with this slightly technical and slightly complicated part, I'm giving you a break so that maybe in the break you can rethink on this. If there is a still doubt on this, we will again discuss. No problem. Fine, students? Break. Let us continue. So now I'll take your questions before I proceed. So tax liability computation. First is Sridhar is asking tax liability computation cost inflation index is not included is correct. See, Sridhar, I'll tell you again what I mean. See, when you're doing computation, when we solve sums, we have computation of income first. Income from salary, income from house property, income from business and profession or PGBP, then income from capital gain, income from other sources. Now here what you write your incomes or losses, GTI, deduction under chapter 6A, and then taxable income. On this taxable income, you have tax liability, which is the tax amount. Now understand this. Firstly, the rule is indexation has now stopped, has been discontinued, so indexation benefit is not applicable. First rule. When I say indexation benefit is not applicable, it means you have to do computation like this, which is without indexation. So you will take 10 lakhs as the cost as it is, no inflation, right? This is what is the meaning of indexation benefit is not available. So this will be your income, 24.9 crores. So over here, you will write long-term capital gains, 24.9 crores. Now this rule applies to everyone, even to individual HAFs for land building, which is given to them as only one case of indexation as an option. Even for them and for everyone, the capital gain will be calculated, will be computed always without indexation. So as I wrote over here, in your computation of income where you write the final incomes and losses of each head, capital gain will be written without indexation. Okay? Now, when you will be computing this tax liability, which will be by way of a working note. In that, if this capital gain which you had computed is of individual or HUF and the asset is land and building, then they will make two computations, option 1, option 2. Without indexation, you will take this amount, 24.9 CR into 12.5%. And option 2, with indexation, you will take this amount. That was after deducting the index cost, inflated cost, which is 20 crores into 20%. Now this comes to 4 crores and this will come to some 3 point some crores. Now what you will see that since my tax liability over here is lower, so final tax liability which I'll be including it of this amount. If let us say this had come as 2 crores, so if this is lower, while writing the tax liability, you will take the tax liability of this option, which is the indexation option. Now, importantly, even though if this liability is lower and you have taken that liability in your final tax, still the income which will be shown will always be shown as without indexed income, because the indexation concept is now only in the tax computation that is here. Indexation option is not here. So in computing income, you have to compulsorily compute income without indexation. So right now, when we are solving capital gains, Here we have to only compute the capital gain, income or loss. We are not going to go to the tax liability in this chapter. So for us, for the time being, you can just keep in mind that there is no indexation, right? When you go to tax liability calculation, in that tax liability calculation chapter, again, income which you will write in computation will always be without indexation. Only in the tax liability computation working note, if the person is individual HUF, if the asset is long-term land and building, then while computing the tax liability on this long-term land and building, you will check both the tax options, tax on indexed amount, higher rate of tax, tax on without indexed amount, lower rate of tax. And then after comparing the tax, whichever tax is lower, that tax will be written here. But the income will always remain without indexation. Students, is this point clear? Also important point, indexation which you will be doing here applies only for individual HF, only if the asset is land and building and only if it is long term. Indexation earlier also was never allowed for short term. In fact, one of the reasons for making long term and short term different was that short term was always done without indexation, and for long term you had indexation. This was earlier. Today, since indexation itself is removed, so now there is no indexation for long term. Anyways, it was not there for short term. So in short, now long term, short term has become same as far as computation is concerned. There is no indexation. Only in tax computation for individual HF, if the asset was land building and if it was long term, they have this option of indexation. Short term never had indexation option earlier also, today also. Long term earlier had, today it also does not have. So today all computations, long term, short term, for everyone, for every asset is done without indexation. Fine, students? Super. Okay. Can I proceed? So this is again the second important point about computation, that is about the indexation point. So in short, today, no indexation has to be taken. Now, these are the indexation rates. As I was explaining you here, how do we index? In the numerator, we take indexation rate of current year. In the denominator, we take indexation of that respective year. So let us, in my example 4-5, we will take in the denominator 113 and in the numerator, we will take 376. This is the methodology. Correct? Fine. Now, there is something for ESOP, there is something for non-resident. These few things I'm keeping aside, students, that will complete at the end because these are only theoretically important. We have to first understand what is practically important. Now, practically important is the computation part, in which, as I'm explaining to you, you can see here in computation, we have to decide all these things. Now we have started discussing these things and I have first given you the general rule for everyone. So what is your full value of consideration? It is whatever consideration is received against transfer of the asset. If money is received, then money. If asset is received, then FMV of the asset. Second, you have to subtract cost of acquisition. Third, you have to subtract cost of improvement. Cost of acquisition, the general rule is, what is your cost of acquisition? Cost of acquisition is the purchase cost of the asset plus all expenses incurred until the asset is ready for use, right? Now, we will start studying the exceptions to this and all the rules. Now, the first exception is under 49 bracket 1. What does 49 bracket 1 says? It says your cost of acquisition is cost of acquisition of previous owner. What is this? So I'll give you an example. The example is my dad purchased a building. This building was given to me by my dad as a gift. All these things happened in the past. Today I am selling the building. Now today when I'm selling the building, I know the sale price, so full value of consideration is known. Now when I have to subtract the cost of acquisition, if I go by this original rule, what is the original rule for cost of acquisition? It says it is my purchase cost or construction cost. Now actually my purchase cost, construction cost is zero. I had received the asset as gift. Now, if I go by the general rule, my cost will be zero. But the law says, no, wait, there are exceptions. And the first and the very important exception point, which will be used in many questions, is your cost will be taken as cost of your previous owner. Now, in which cases you have to follow this rule? It covers all those cases which are covered in 49.1, and 49.1 is already explained to you here. If you remember my golden rule 1, what was my golden rule 1? Where you have purchased any asset and it is purchased or received by you in one of the modes, one of the scenarios which is not transfer, then 2 points. Your period of holding includes period of holding of previous owner. This we studied in the previous class. Plus, I had written the other point. Your COA is COA of previous owner. This is what I'm writing now. This is what is given in 49.1 section. And this same example I'm explaining to you. So my father had purchased the house. Later on, my father gifted the house to me. Now, when my father gifted the house, at that time, for my father, there was no capital gain applicability. Why? Because gifting is not transfer. So when my father gave the house to me by way of gift, my father did not have to pay any tax. Today, I am selling that house. For me, while deciding whether this house is long-term, short-term, I will not only count my period, I will also count period of my previous owner, which we studied in the previous class. Plus, while deciding the cost of acquisition, I'll take cost of acquisition of my dad, that is my previous owner. Why? Because of section 49.1. But before I take you to 49.1, there will be around 20 sections. I repeat, 20 or even more sections, all talking about the same rule. So I've converted this into golden rule, where I've made the rule in the form of this one sentence, that if you have purchased, received the asset in one of those modes, one of those scenarios, which is covered in the not transfer list, then you have to remember under various sections, 49.1 and all other sections which we are going to study, your cost is cost of previous owner. Right? Is this clear? Now here, I want to add one word, previous owner or previous asset. Now, what I mean by this previous owner or previous asset, that I'll explain as we proceed. So I hope firstly the general important point is cleared. Now see, this is what is 49.1. What does the section says? Where a person becomes owner of the capital asset, not by purchase, but also by several other methods, then section 49.1 gives you guidelines how to compute your cost. Now, what does 49.1 says? It says that where capital asset is acquired by you, how? In one of these mediums. Now, just read the list. I'm sure you all recall that these are the same situations which we studied in not transfer. Just go through the list. See, First what? Partition of HF, an asset is distributed by HF to members. Then gift will, then succession inheritance, then distribution of asset at the time of liquidation of company, then transfer to trust permanently, that is donation, then holding to subsidiary, subsidiary to holding when it is 100% holding subsidiary, then at the time of amalgamation, at the time of demerger, at the time of conversion of individual property into HF property. All these are the cases, students, we have studied in not transfer list, right? In all these cases, what is the rule? What is your cost of acquisition? Your cost is the cost for which the previous owner had acquired it. So your cost is cost for which the previous owner had acquired. So in short, your cost is cost of previous owner. Is this clear? Any questions on this? What you have to only check, one rule. Did you acquire the property in any one of those mediums which you call as not a transfer? If yes, whatever is the medium in which you acquired the asset is not a transfer, answer is simple. Your cost is cost of previous owner. Similarly, same rule for cost of improvement. What is your cost of improvement? The cost of improvement for you is the cost incurred by the previous owner. With one condition, it should be incurred after this date. Why this rule? That you'll study later. But first rule, your cost of acquisition, your cost of improvement is cost incurred by the previous owner. Yes, students, I'm waiting for your questions. Yes, now this is interesting. I was expecting this. Now, Anshika has raised a very interesting query. Sir, what if previous owner had also acquired it in one of these methods, right? So I'll tell you my real example. In my case, the house which I am having was actually 4 generations old. My great grandfather had actually purchased it. Then it was given by way of will to my grandfather. Again, my grandfather by way of will gave to my father. My father now here actually have not purchased this. He has also received under the will, has gifted it to me. Now for me, what is my cost? My cost is cost of my previous owner. When I check the cost of the previous owner has also acquired it under will. So for previous owner, the cost is cost of his previous owner. And that person has also acquired in will, inheritance, whatever. So for that person, again, the cost is cost of his previous owner. So for me, my cost will be the cost of that previous owner who had firstly purchased it. So in case of this, like in case of many of us, our properties are inherited or transferred under will over 2 or 3 or 4 generations. So for you, the cost is cost of very first person who purchased or constructed it for the first time. Correct, Anshika? I hope this is clear to everyone. Super. Everybody else, things are clear, easy. Arun beta, have patience. Have patience. Right, students? Should we proceed? Now, Arun is asking question on this. What is this? See, we studied one exception of not transfer, HF giving the property to members, right? That is this point, first point. So that is point 1. Point 9 is exactly ulta. Member is converting his personal property to HF property. Means member is giving his separate property to HF. So now the individual property becomes HF properties. So same, converting individual property to HF property. Again, same rule. It has been received by HF by way of a gift or will, because only that is how you convert it, by making a gift or a will. Simple. So it is indirectly gift or will, how member gives the property to HF. So what will be the cost to the HF? The cost is cost of previous owner. Sridhar, how this will happen? Sridhar is asking, sir, what if there is no previous owner? How will this happen? In fact, your question should be different. You are not asking the right question. Though I understood what is in your mind, you are saying, what if there is no previous owner? How is that possible? What? Previous owner is saying, Sridhar is saying new home. So, but if it is new home, it means you have yourself purchased or constructed it. So why will you come to this section? Then the normal rule will apply. Na? Why will we come to exception? What is the normal rule of cost of acquisition? If you have yourself purchased or constructed it, it is your purchase cost. So if it is a new home, which you have yourself purchased or constructed, it is your cost. Then why will come to 49.1? Then we get our answer as per our general rule. What is the general rule of cost of acquisition? General rule is, it is your purchase or construction cost plus all the expenses you incurred, like stamp duty, registration, everything. Correct, na? Yes, Ramakrishna.
Sir, where can I get COA grandfather? Because the will cannot say anything
That
cost.
is the point. That is the point. So this is the main point. Again, I'm telling you, this is my own case. What is my own case? My own case is this, Ramakrishna. For me, the cost is 4 generations before. Now, practically, I don't know this cost. This is a reality.
Yes, sir.
I don't know this cost. Now, interestingly, we'll study again in this exceptions. So, chalo, I'm writing over here. You will study. 1 second, I'll change the color. In 49.3, what does 49.3 says? If cost of acquisition of previous owner is not known, and actually in my case it is not known, because if I ask my dad says, I don't know, I got it from grandfather, and grandfather got it from great grandfather, and unfortunately they are not there today, so we don't know how much it is. So for this, the law has envisaged this and it has given the answer. Sorry,
fair market value, maybe we will take that year fair market
yeah,
value.
obviously fair market value of year of acquisition. That is for the very first time when the property was purchased, which in my case is by my great grandfather.
Got it,
right?
sir. Got it.
Perfect. Good.
Perfect.
But still, Ramakrishnan, still, there is a problem in this.
What?
The problem in this. You know what?
Sir.
See, this is where I like this chapter. It brings you to the ground reality. Now you very well recognize one ground reality. Ki, sir, what if I don't know the previous owner's cost, which is possible, right?
Right, sir.
But now there is another problem. This asset in my case was purchased by my great grandfather in 1914. So my house is now more than 100 years old. And obviously now 4 generations have passed. It has to be 100 years old, right? What is the problem, Ramakrishnan, now? Tell me another reality problem. Still this section is no
improvement.
No. It is not improvement. Improvement, okay. Same rule. Problem is this, still this section is of no use to me. Why? How will I get FMV of 1914, boss? From where will I know what was the FMV in 1914?
Okay, 1940, even income tax records also does not have any.
Nobody has records, beta. Even government at time doubt, because at that time it was Britishers. Who knows where the records are, what the records are, and in those times we did not have. Forget about computers. We did not even have proper registers. They were all single pieces of paper, leaves. Not leaves. Leaves is old, very old, but still, the pages were single pages. It was, if you all have seen, it was tied with small thread.
Yeah.
let me tell you, in 1998, when I joined the CA course and I joined Foundation, you will not believe the module which I received was different chapters printed and stapled, and all the chapters which were printed and stapled were tied with a thread and with a hard cover put on the top, and everything tied with a thread. I don't know whether you all have seen those type of books or records. So I'm not talking of very far off 1914. I'm talking of 1998 when I joined the CA course. At that time, the module which I received was received where all chapters were printed and stapled, and at the center they had put a hole, and all these chapters which were stapled were tied together with a thread. And in old times, records were kept like this only, tied with threads. So it means there were single, now I'm talking about the government record, single papers, single pages, and those tied with threads.
So there is no option, sir. You can continue with this.
What?
The era of continuing not to sell. So the problem
But I
is
want to sell, na? And if I want to sell, the income tax is coming behind me asking for tax. So you will get answer for this also. See, that is the beauty. See, taxation will recognize this. When they are making a taxation, they cannot make a taxation which does not have answer to such questions, because if you do not find the cost, if you do not find the value, the taxation will fail, and no government wants that. So we will study later. That is why, see, why these exceptions are, if you understand the reasons, you'll remember and appreciate them, and it will be lifelong permanent. No need to again revise it. So we'll study again another exceptional point, which will give me solution for this also. That what if I don't know the cost of previous owner? What if I don't know the fair market value of that year? No problem. They have given you a solution for this. Fine. That will come to when we'll come to that point. Is this okay?
Yeah, okay, sir.
Super.
Just I got to know that before 2001.
Yes, so that is what is the rule. That is what is the rule. That is what I'm talking about. Correct. So if I don't have the cost, I can take the 1st April 2001, which is available. Correct.
Correct, sir. Okay.
Now Dhanalakshmi is asking, what if your great grandfather's cost is very low? See, I again told you, Dhanalakshmi, the government, the law has nothing to do with whether my cost is low, whether I'm getting high profit. See, in fact, you are saying low cost. Think about me. For me, the property is free. Even that low cost is not my cost, technically. So in fact, the government is very kind in allowing me some cost as my cost and deducting that. If it would have been somebody else, they would have said, boss, pay tax on total value because you have got the asset free. At least they are allowing me some cost, right, Dhanalakshmi?
Sir, in that case, we can go for indexation, no, sir? Not
Again, what is the rule for indexation? Indexation is applicable to me in my case, right? For
Yes,
me,
sir.
it is applicable why I am individual and the property is building, and it is the purchases before that 2024 date, correct? So
Correct.
indexation is applicable to me, but not now. Now means when I'm doing computation of capital gain, I have to do it without indexation. When I'll be computing the tax liability at the end, at that time I'll check both the tax with indexation, without indexation, whichever is lower, that tax I will pay. But income will be calculated without indexation.
Even though you selected, you opted optional tax regime, not default tax regime.
See, this point has nothing to do with optional tax regime. Had that been the case, we would have studied it here itself. So this rule that indexation is not available is same in the old regime, new regime. So there is no difference of regime.
Okay, sir.
See, in fact, till now in capital gains, we have not studied even a single provision which is different for new and old regime, right?
Right, sir.
See, the maximum difference in new and old regime was in salary. Then come to house property, only one difference. Then come to PGBP, only two difference. Come to capital gain, only one difference, that also very small one. So it is not that every chapter will have difference of new regime, old regime, right?
Right, sir. Thank you.
Super. Yes, Arun. Yes, Krishna. That is what is the next exception we are going to deal with. Dhanalakshmi, your logic is correct, but for that we have a specific provision. So you can take that 2001 FMV. We'll study that provision. Arun is asking if the government is allotted a flat for free of cost. Name. See, Arun, Again, the point is why a free flat is allotted. See, it cannot be hypothetical. It has to be a real life case. In what case flat is allotted free? And in any case, if it is allotted free, it will be considered as gift. And the moment it is considered as gift, 49(1) applies. Your cost is cost of previous owner. Why to take fair market value? We have an answer, na Arun? Firstly, whether this is happening, I don't know. If it is still happening, then I've given you the answer. If you are allotted flat free by the government, I don't know where it is happening, but wherever it is happening, let us not argue that. But if you are given flat free, your cost is cost of previous owner. Who is the previous owner? Government. So you have to find out the cost at which government had purchased, constructed that flat and given to you. Simple. Because it is falling in 49(1). Because when government is giving it to you free, it is free means it is gift. Correct, na? Great. Super. Now, this was all 49(1), in which your cost is cost of previous owner. Now the remaining sections, which are all the cases of not transfer, for all those cases, again, your cost is cost of previous asset. Now here that other point will come. Your cost is cost of previous asset. I'll say, sir, what do you mean by cost is cost of previous asset? So let me take example. Now we are talking the scenario of amalgamation. Now in amalgamation, there are two possibilities. First, which is covered here, amalgamation possibility, and also chalo demerger. We'll study both together. But here, what is amalgamation demerger? Old company giving away the business to new company. Now this amalgamation is not regarded as transfer. We already studied. So for new company, what is the cost of all these assets? It is the cost or WDV in the books of old company as per 49(1). Now here again, what is this amalgamation? Here the amalgamation is of the shares. Now, if you remember, at the time of not transfer cases, we discussed this. You are a shareholder of old company. Now amalgamation has happened. Old company has got merged into new company. So there is now no old company. Now in this case, where old company has got merged into new company and there is no old company now, what you will do with the shares of the old company? So practically what happens? You give away these shares and in exchange, you receive the shares of new company. So now today you are having the shares in the new company, which has formed by way of amalgamation as per the scheme of amalgamation. Now the question is, what is the cost of this new company share? The answer is simple. How did you acquire this new company share? At the time of amalgamation, this exchange had taken place whereby you gave away the old company share and you received the new company share. So you have acquired the new company share by way of exchange in the course of amalgamation. And this exchange again is not a transfer. We have seen this. Now, if it is not transfer, our golden rule applies. And as per our golden rule, what will be the cost of this? It will be the cost of previous asset. So let us say you had purchased the shares in the old company for ₹90. So by default, the new company shares which you have received after this amalgamation, for you it is 90 only, because for you what has happened? It has flipped. You gave away company A shares, you received company B shares. So now for you, logically also, if you think company B shares has costed you how much? Same 90 rupees. This is where I have just added one word in my golden rule here. What is that word? Your cost is cost of previous owner, and in some cases it is cost of previous asset. So wherever the assets have flipped, and that you have numerous cases, amalgamation, demerger, preference to equity, debentures to equity, so many cases where asset has got flipped with asset, gold converted to electronic gold receipt converted to gold. All these are not transfer. What is the cost of new asset? The cost of new asset is the cost of previous asset. Because how did you get the new asset? By exchange, and that exchange was not regarded as transfer. Clear, na, students? So now you have all those cases where your cost of the new asset is the cost of the old asset. So first is the case of amalgamation. Second is the case where the old asset is converted into a new asset. So you become owner of shares. How? By conversion of bonds or debentures into shares. So what will be the cost of the new shares? It will be the cost of the earlier bonds. Same rule, same golden rule. Why? Because this is not transfer, right? Same, where you became shareholder in equity shares, that you got equity shares. How? In exchange of preference shares. Again, what is the cost of new equity shares? It is the cost of the earlier preference share. Same rule. Why? Because this is not transfer. Now, another scenario of not transfer is demerger. But now here it is going to be interesting. So you are shareholder of old company, which is A Limited. Now in demerger, this A Limited got split into two parts. Some part of this company became B Limited and the remaining part was A Limited itself. So A Limited continued, but some part of it got demerged. First possibility, or second possibility, it got split into two new companies, B and C. Both are demerger. Now, what has happened to you? In your hands, you had one share, that is share in A Limited. You had to give away these shares, and in exchange, you receive two shares, share in B Limited and the share of the new A Limited, which is now a smaller A Limited. Why? Because it has got split. So it is, let me call it as A dash Limited, because it is a smaller A company. Right? So in demerger, this will happen. You will give away one old share and you will receive two new shares. Now, firstly, this exchange is also not a transfer. Now the question is, what is the cost of your new company shares? Same rule, same golden rule. Cost is cost of previous asset. Now let us say you had purchased this for 250 rupees. So we are saying what is the cost of new company share? It is 250. But now in new, you have two companies. So what we have to do? We have to do proportionate. What is this proportionate? Now I want to find out my cost of new company share, which is B. What you have to do? You have to take cost of old company share, 250, and proportionate it. How proportionate? You'll have to find out the net asset which are transferred to B Limited. So in demerger, when you split, you transfer some of your assets, liabilities, you divide it between both the companies. So you have to find out what is the net asset transferred to B Limited and what was the net asset. Now see, when I'm saying net asset, you can also call it as net worth of old A Limited. So in short, out of the total net worth of A Limited, how much of net worth, I'll just change the word net worth so that it is easy. How much of net worth is given to B Limited? So let us say this old company's net worth was 500 crores, out of which 300 crores of net worth or net asset is given to B Limited and remaining 200 crores are with A, which is now a smaller A. So how will this working happen? In this working, 250. Okay, I'll just change this. What is 250? 250 is cost of acquisition of old company share. So it is 250 multiplied by how much net worth B Limited received? B Limited received 300 crores. Out of total net worth of how much? 500 crores. So by default, this proportionate will become for you the cost of B Limited. How much? 250 into 3 upon 5. So for you, out of this 250, 150 will be the cost of B. Now on similar lines, you can find out cost of A. So what will be the cost of this reduced A dash Limited? Now you can do the same proportionate working, or simply what you can do, cost of acquisition of old company share, that is 250 minus cost of B Limited, which is calculated above. So 250 was your original cost minus how much you calculated above. You calculated for B Limited the cost as 150. So now what will be the cost of A? 100 rupees. Logical, no? If out of 250, 150 is cost of B, what will be the balance cost of A? 100. That is what is the answer given here. What is the cost of acquisition of original shares after demerge? It shall be deemed to be reduced by the amount arrived above. So what you arrived here for B company, that is to be reduced from this balance, is the cost of this A company shares. Logical, students? So for amalgamation, it was one given, one taken. So whole cost of old company share became the cost of new company share. In demerger, it got split. So you have to use simple ratio, simple maths, and very logical. Any doubts or questions, students? Students, I'm waiting for your response. Very good. What about others? Yes, Krishna, you will give a effect. Why you have this doubt? Enam, which first part you did not understand, Bida? You may unmute and ask so that I'll also be able to explain properly. Krishna, I'm still not getting you. See, if you are saying it is the default regime, means the new regime, then the rule is clear. In new regime, additional depreciation is not allowed, Krishna. Correct, na? So I'm not getting why you are having this doubt whether additional will be allowed or not. In new regime, additional is not allowed, so that will not be subtracted. Enam Beda, what is your question? I'm still waiting for your clarification. So Krishna Beda, then I'll have to see what you are talking about. I don't know what you are talking about. Also, let me inform you, some 2 or 3 years back, the old scheme was called as the default regime and the new scheme was the optional regime. Then if I'm not wrong, if I clearly remember, in 24 itself, they changed this. They said now the new scheme will be the default scheme and the old scheme will be the optional scheme. So I think if you are getting this confusion, then the confusion would be because the question may be of past period where the old scheme was the default scheme. Right, Krishna? So I think that is why this confusion is there. Beta, you are talking about attempt. I'm talking about the previous year. It is of which previous year, beta? It is of previous year 24-25. So you'll have to check when the scheme became what. So that's what I'm saying. Either you take a screenshot and put it here, because see, I cannot answer vaguely. I'll have to see what you are talking about. So you put it here. Let me read the question so that I can clarify your doubt. Correct? Now the same rule again applies here. What is this case? You had converted your gold into gold receipt, right? So gold converted to gold receipt. What will be the cost of acquisition of this new gold receipt? It will be the cost of previous asset. Vice versa, gold receipt was converted to gold. So now what is the cost of this new asset gold? It is the cost of the previous asset, which is the gold receipt. So see, in all these cases, even though the section numbers are different, right? What golden rule follows, and that is why I'm calling it as golden rule. The golden rule is this. You have to check, did you get the asset in one of those methods which the law says this is not regarded as transfer? If yes, if it is not regarded as transfer, then for you, the cost of acquisition will be the cost of previous owner or previous asset. Where this previous asset will come, where the asset has exchanged, the asset has flipped. Right, students? Clear? Understood? Now, let me call this as golden rule B. Now I'll give you one more golden rule. Now this rule, slightly you have to understand, where at the time of acquisition or receipt of capital asset, it was taxed. Now this is something which you have to understand. I'll explain what it covers, but let me first write the golden rule. So where at the time of acquisition of receipt of capital asset, it was taxed. Cost of acquisition is the value taken for taxing the receipt of capital asset. Now what I have written will be slightly at start difficult to understand, but when you take the examples which I'm going to give you, it will be easy. Now what is my example to explain this? So let me first take the example. So as you can see, I have left few things in between. Why? Because they are dealing with some other golden rule. Now what is my example? You are an employee. Pay attention. You are an employee of a company. Now it is the policy of many companies that if you are working for some continuous number of years, the company, after completion of those number of years, gives you its own shares, either free or at a very low price, which are called as ESOPs, employee stock option plan shares, or even sweat equity shares. Now you have studied this in salary chapter. What you have studied, that as an employee, when you receive this ESOPs, it is taxable to you as a perquisite under salary head, under section 17(2), which is the definition of perquisite, which is treated as your income from salary. So let us say in 2023-24, your company gave you its own shares free. which is called as ESOP or sweat equity shares. Now, what happened in 2023-24? You had to pay tax on receiving the asset. See, in capital gain, when do you pay tax? When you sell the asset, right? But there could be some other heads where when you receive the asset, you have to pay tax. Like this is one simple example. Few more cases are covered that will come later as we go to them. So at the time of receiving the asset, here the asset is what? Shares. Shares of your own employer company, which are called as ESOPs. When you receive the ESOPs, income tax taxed you the value of those shares as your perquisite income. Or you remember this. 17.2 read with rule 3, where the valuation of this perquisite is given. What value it had taken over there? The value taken was the fair market value of the share on the date on which the option of ESOP was exercised by you. In short, the option or the ESOP was received by you, right? If you remember salary chapter. So you paid tax on this ESOP shares at the time when you received it. It was taxed to you under the head salary. Now this happened in 23-24. Now today you want to sell the shares. Now when you sell the shares today, today's sale price will be your full value of consideration, no doubt. What will be your cost of acquisition? So my golden rule says what? Now read my golden rule. Where at the time of acquisition or receipt of a capital asset, it was taxed. I'll add the word under any head of income. So like here, it was taxed under the head salary. So where at the time of receiving the asset, here what is asset is received, shares are received. It was taxed under some head. Here which head? Salary. So now what is your cost of acquisition? The cost of acquisition is the value which was taken for computing your tax under that head. Now in salary head, what was the value taken to compute your salary head income, which is perquisites of ESOPs? Fair market value of ESOPs were taken. So the value which was taken over there as your income of salary, that value is to be taken over here as cost of acquisition of those shares. I hope you understood this point. Now this point will be repeated in 2-3 more sections. That is why I have made it a golden rule. What is a golden rule? A rule which covers multiple sections into one statement. Did you understand this point, students? Is the logic clear? Understand the logics. The more you understand the logic, easy it will be to remember, because a bigger challenge in capital gain is remembering. There are so many provisions, correct? But when you link it like this, first main rule and exception, it is easy to remember. Plus in exceptions, if you understand the logic why those exceptions are created, it is even more easy to firstly understand, and then it is also remembered easily. Obviously, you should keep on revising this. The more you revise, the more it will be consolidated in your minds and heads. Same rule, where you had received some property which was already subjected to tax under 56(2). Now this is what? Gift, which had income from other sources. I'm sure by now you know that if you're receiving gift from unrelated persons, they don't have to pay tax. Why? Because when they are giving you gift, for them it is not a transfer, so no tax in their hands. But in your hands, that gift is taxed to you under the head other sources. I'm sure you know this. We'll study this in detail in the other sources chapter. So when you are receiving a gift, right, that gift is taxed to you in the head other sources. Now, what is that gift received? Let us say jewelry is received. Let us say shares are received. Let us say building is received. Whatever you have received as gift, and it was taxed to you under other sources. What will be your cost? Your cost is again our golden rule, which says it will be the value which is taken into account for the purpose of computing your gift income under the head other sources under section 56(2)(10). Right, students? Third situation falling in this golden rule. Now, what is this situation? Situation is stock in trade converted to capital asset. Now, if you had something which is your stock in trade, now you say, okay, now I'm closing down this business. Like if you remember my example of this is that you are a builder, you had constructed a building with multiple shops. You sold most of them, 2 were left. Now, after that project, you decided to discontinue that business and start a new business. And in this new business, the 2 shelves which were unsold, you start treating them as your office. So what was your stock in trade in that old construction business in the new business is now treated as your capital asset. If you remember, this is income under the head PGBP under section 28. This was the only point which I had left while I was teaching PGBP. I completed it now when we were studying transfer and not transfer, because over here it is ulta. CA into SIT is transfer here. So vice versa, SIT into CA is transfer over there. Now again, what has happened? When you converted your stock in trade into capital asset, this was taxed under section 28. And what value was taxed? It was the fair market value of the stock in trade, which has now become your capital asset. So now what will be the cost of acquisition of this capital asset? It is this FMV for which you have already taxed. You have paid the tax at the time of converting it from stock in trade to capital asset. So at the time of receiving capital asset, if it is taxed, the cost of acquisition of that capital asset is the value which was taken for computing that income. Now this income is under the head PGBP. So 3 scenarios: gift income under the head other sources, conversion of stock in trade into capital asset under PGBP, and this perquisite income under the head salaries. In all these cases, at the time of receiving the asset, you had to pay tax. So see, all scenarios are now covered. All special cases are covered. Right, students? Clear? Understood this entire table? Fine, students? No doubts? Should I proceed? Arun, which case is this? Case 1 renouncement, but it has not yet come, na? We have not yet got the case of this. So let me come to that section. There is a section for this, Arun. Don't worry. But let me come to that section, because if I start mixing other things for students, it may be difficult. It may be complicated. So let me go step by step. I'm going in the flow of this module so that for everyone, it is easy to comprehend. If I jump to some future section, you may know that section, but other students are not knowing. So it will be confusing for them, right? Okay. So what is the rule for cost of acquisition? Section 49, many sections. Cost of acquisition is amount or value considered for computing income under other heads, right? So this is our golden rule B. This is our, where should I write? This is our golden rule A, right? Now, we come to next. Next is this point. Now here, they have given the heading as cost of acquisition, where they have given the original rule that cost is the price which the assessee has paid to acquire and all the expenses incurred like stamp duty, etc. Now, the special cases. Now, what is the special case? Special case is intangible assets. Now, for intangible assets, what is the rule? Now, in intangible asset, students, there are two possibilities. What are those two possibilities? Purchased or self-generated. Purchase or self-generated. Now see the examples given over here for intangibles. What are the examples given over here? Goodwill of business, profession, trademark, copyright, right to manufacture, produce any article or thing. So these are all intangible assets. Now for intangible assets, what is the cost of acquisition? The answer is the cost of acquisition in case of intangible assets. If the intangible assets are purchased by you, it means you purchase somebody's business, and at the time of purchasing the business, you also purchase their goodwill. Now, when you have purchased the goodwill, the cost of acquisition is why I'm writing in blue, because actually it is not our exception, it is the general rule. So if you have purchased the goodwill, your cost of acquisition is the actual cost of purchase. Now, what is special or exceptional? If the goodwill is self-generated. What is self-generated? I started my own business, and after 20 years, now my business has grown a lot and my business has got a good goodwill in the market, because of which I am directly getting customers. This is what is goodwill. Now, in such cases where I am having a self-generated goodwill and this goodwill I sell it in future to anybody else, the law says cost of acquisition is nil. So cost of acquisition in case of intangible assets, what is the special rule? If you have purchased an intangible asset from someone, cost of acquisition is our actual cost of purchase. If it is self-generated, cost of acquisition is nil. Right, students? Clear? Then in case of acquisition of previous owner, the answer is same. Then in case of circumstances mentioned in 49.1, we have already studied cost is cost of previous owner. It is just a repetition done by them. Correct? Self-generated asset, I just explained, it is nil. Now coming to financial assets. So after intangible assets, the next category is financial assets. Now, what are financial assets? These are shares, debentures, bonds, mutual fund units. All these are financial assets, all securities in short. Now the question is, what is the cost of acquisition? See, again, the general rule is cost is the price at which you have purchased these shares. However, now there are some special scenarios. First is, what is the cost of original share? The cost of original share is the amount actually paid for acquiring the original shares. Now the main part is this. On the basis of original shares, in future, you are given rights. We had discussed about this when we were discussing period of holding also. So I had purchased shares of, let us say, Tata Company in 2022. Today, the Tata Company wants to bring out more shares. Company law says you have to first offer it to the existing shareholders. You have to give them a right to purchase the new shares. Now, when they are giving me right to purchase the new shares, I have an option of either exercising the right myself or selling the rights to outsiders. Now, if I do not use the right myself, I sell the rights to outsiders, it is called as renouncing the right. Renouncing the right means I have not used the right to purchase the shares. I don't want more shares. So I'm selling the rights itself. Now, when I'm selling the rights to outsider, my cost of acquisition of the rights will be nil. So it is again, you can say in other words, intangible asset only, but given separately. So I'm writing separately the right to purchase shares. What is the cost of acquisition? Nil. So rights to purchase shares, that will be nil. Why? Because it is like intangible only, and we have already covered above. For all intangible assets, whether goodwill of a business, goodwill of a profession, patent, trademark, copyright, I already explained above. For all intangible assets, the rule is if it is self-generated, it is nil. A right is also a self-generated asset, it is nil. Now, what will be the cost of the right shares? Again, it is the amount actually paid because right shares I have actually purchased, right, by paying some amount. So for me, it is the amount actually paid. Now, what about bonus shares? Again, for bonus shares, there are two rules. The main rule is the cost of acquisition of bonus shares is also nil. However, we'll study there are two parts in bonus shares. First part is nil. So, rights to purchase nil. Bonus shares, there are two parts. First part is what we are studying now. It is nil. Now, here is the second part. I'll come to this part later on because this will require some in-depth understanding and explanation. So allow me some time. I don't want to overburden everything at once. Let me just cover simple things. Then come right shares again. But now these are which right shares? These are where you are not the original shareholder of the company. Let us say I am the original shareholder of the company. Same example, Tata. Tata gave me rights to purchase the new shares. I don't want to purchase. So what I did, I sold these rights to you. Now I sold these rights to you, not free, at rupees 20. So firstly, I charge you rupees 20 for the sale of my rights. So when I have sold the rights to you, now you become entitled to purchase the right shares and you have got the right from me by paying 20. And now you pay the cost of right shares because now you're going to purchase it from the company. Company is charging 65 rupees. So for you, what is the cost of right shares is firstly the rights which you purchase from me and then the price of the right shares which you pay to the company. So which right shares they are talking about? Which is purchased by the person in whose favor the rights are renounced. So I sold the rights to you. Sale is also renouncement of rights. So I renounce the rights in your favor. I sold the rights to you. And using these rights, you purchase the right shares. So first you purchase my rights for 20 rupees. And then using those rights, you purchase the right shares from the company for 65 rupees. So for you, the total cost is addition of two amounts. Correct? What are the two amounts? So here they say cost of acquisition is equal to what? It is the aggregate of first the purchase price of these shares and the price for renouncement of rights. So first you are purchasing the rights for which I have charged you 20. And then finally, whatever amount you will pay to the company for purchasing the right shares. Correct? Now see, these are all logical points, but they are all given separately, specifically in the law. Understood, students? So we have covered so many things today. We will pause here. We'll continue something more. So this part will continue in the next class. And we will also now start solving sums. Fine, students. Is this very clear to everyone? Anybody, any further questions, doubts? Please feel free to ask. Yes, students. Anybody, any questions or doubts? See, these are the various special cases which we are going to study as we proceed. But now in the next class, before I proceed with these special cases, we will first now solve sums on whatever we have studied till now, so that those things will get consolidated in your minds and we will proceed further. Okay, students? So thank you. See, capital gain is very vast. As you can see, it has so many carve outs, it has so many different ifs and buts, and that is why taking notes like this becomes very helpful. Also try to use colors like how I have used. So my main color is blue for the main provision. Then for exceptions, it is red. Exception to exception is green, which will obviously then be part of blue only because exception to exception means the same provision, right? So this is how you should also develop the habit of taking notes. So I'm purposefully writing it in front of you because I also want to develop this habit, this approach in your mind. So I'll be sharing this later at the end once I complete this. Excellent. Arun is asking where I will get questions to solve. See, Arun, you have to go to our website, BOS portal. You will find the every attempts MTPs, RTPs. Why? I'm saying only that attempt because maybe for previous attempt, the old Finance Act is applicable, but now in previous you had 3 attempts. So maybe you'll also find 1 or 2 more attempts, MTP, RTPs relevant to your attempt. So whatever MTP, RTPs are relevant to your attempt, please use them. That will be more than sufficient. You can also go for past MTPs, RTPs, but over there you should then need to know what is the change, right? Guru Dayal is asking, sir, I have books relevant for May 25. Is there any change? See, beta, for this, again, I'll say go to our portal. There is one section in our portal called as statutory updates. So one option, yes, we are saying either you purchase the new book if that is comfortable to you. If not, then in your old book, keep that old book and just download the statutory updates. Now in statutory updates, what we do, we include all the amendments that come after the print of that book. So if you see the statutory update, at the start we write this update is applicable after this printed book. So you have to see the printing date of your book, which is written on in the first 2-3 pages of your module. And after that, whatever statutory updates are uploaded till your exam dates, download those statutory updates. And we have even given for each chapter wise amendments, you just mark it in your old book. That will be fine. So one option, if possible, purchase our new material, which you can order and purchase. If not, in old material, which you have already received, download all the statutory updates, maybe take a printout of that so that both are physical, the module also and the updates also, and mark those changes in your old module. Fine, beta? This is clear to all students? Everything, whatever we discuss, whatever I explain. Okay? Perfect. Done. No doubts. Please revise. Please read whatever we are doing on a regular basis. So I'm going through module. You have to simply complete the module to that page till which we have completed. In between, I have left out something, no problem. Either you leave it out or just read it once. No problem. Fine. Thank you all. Thank you very much, students. And good day. Please keep studying. Yes, Sanketji. Thank you very much. Good day. Thank you all.